Talk to me.
So that line sticks. It goes on to say, in order to retain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time, in determining the extent of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects activity and inflation, and economic and financial developments. In addition, the committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities, Lisa, as described in its previously announced plans. The committee is strongly committed to returning inflation to its 2% objective.
I would say that this is a Fed holding close to its vest, but I think you pinpointed the key phrase. They repeated that further rate hikes would be appropriate, and that seems to be what markets are responding to.
Let's pick up on the price action just briefly. Your equity market is lower by 0.5% on the S&P. On the Nasdaq 100, we are down by 1/3 of 1%. Looking into the bond market briefly, we are higher at the front end by about 3 basis points, so that ongoing increases phrase sticks in a statement. We'll catch up with Mike McKee in just a moment on that. Your 2-year at the moment is 4.23. Your 10-year lower by 3 basis points at 3.48. The curve a little bit more inversion here. 2's 10's down to -74. We're down about 5 or 6 basis points. So TK, it's over to you, Chairman Powell, in about 28 minutes.
This is exactly the chart I look at. For those of you on Bloomberg Radio, it's just simple. 2's 10 spread makes a leap here. And John, to get out beyond 80 basis points, a difference in yield of 0.80% would be an extraordinary statement by the fixed income market on this Fed.
Do we get some heavy lifting, Lisa, from Chairman Powell at that news conference to push back a little bit more against this idea that we get cuts sometime soon?
That will be a fascinating development. Even more fascinating, will those price moves stick? Will the market believe the sort of hawkish tone to this idea that there are ongoing rate hikes that are still appropriate in the face of diminishing inflation?
I always find these meetings very strange because you don't get the projections. We've got to wait a couple more months.
Totally agree.
Wait for the March meeting for the projections. So this one's a simple one. There's the statement, a 25 basis point hike in the rearview mirror. In front of us, 27 minutes away, is a news conference with Chairman Powell. Joining us now, I'm pleased to say, is Diane Swonk, the chief economist at KPMG, and Mike Gapen, the head of US economics at Bank of America. Diane, first to you. Your response to those words from this committee this morning, or rather this afternoon?
Not at all surprised. This is a Fed that really has been pushing back, particularly on the easing of financial market conditions. They don't want financial markets credit easing to undo the progress we've seen on inflation. And given today's job openings data with 11 million at the end of December, 1.9 job openings per job seeker during the month, that is in the wrong direction for the Fed, along with announcements by the largest employer in the country this month that we'd see an increase in entry-level wages from $12 to $14 per hour. And that is something that the Fed does not want to see. They're not only worried about setting too high of a floor under inflation as it comes down, they're going to be worried about a reacceleration in inflation in the months to come and a reacceleration in wages. They want wages to accelerate without inflation. The hard needle to thread here is to slow inflation more rapidly than they cool wage growth.
Michael Gapen, what's your reaction to this statement? Pretty much in line with exactly the expectation that people had. What's your main question for Fed Chair Jay Powell in about 25 minutes' time?
Well, I would say I have two questions. Is essentially the extent of further rate hikes. So they modified that language. We had expected that, right? Are you still thinking something a little bit above 5%? Is appropriate? And then maybe a follow-on to that, I'd echo what Diane said. The labor market is quite solid. The data today doesn't suggest it's slowing down all that rapidly. The other thing I would say, so how else could the Fed push back against expectations of easing, for example, that are not related to the policy rate? Governor Waller brought up this week, or last week, I think it was, before the blackout, that maybe we can run our balance sheet off even as we're reducing rates. So is there guidance here that's more than just about policy rates, Could it be something around the balance sheet? So if they were concerned about financial conditions easing too much, might that come to the forefront and be on the table?
Meanwhile, there is a question, Diane, about whether the market is actually acting appropriately and whether it's really the Fed's job out and distinguish what's Fed policy and what's just fundamentals that might be perhaps turning around. What are you looking for in terms of their guidance of whether to go further, how much further to go, and where the balance of risks is in going too far or not enough?
Well, I think they're more than willing to actually look at the economy and saying where we are today, they're more willing to risk overshooting than undershooting. And the reason for that is that balance sheets have healed dramatically from where they were, not only household balance sheets, but corporate balance sheets. And that's why they're so worried about financial conditions offsetting and moving in the opposite direction of where they're going, because it actually could not only undo the progress they've made on inflation, but actually trigger more inflation. And that's something they're very concerned about, is that we're now in an economy, a mirror image or reverse image through Alice's proverbial looking glass from where we were. Instead of them trying to raise rates and finding the economy responded too much every time they raised rates, they were able to raise rates a lot last year. And it now looks like the economy is more susceptible to rate cuts and easier to stimulate. And so that also feeds into a bias to overshoot in rate hikes rather than undershoot. They don't want to repeat the mistakes of the past. They're haunted by 2021. Governor Waller also made reference to that they had a 3-month improvement in inflation in 2021, and then were head faked. They don't want that to happen again. But they're haunted as well by the 1960s and 1970s and the stop and go policies of then. They see this as a marathon, not a sprint. They're not going to stop till they cross the finish line. And that means getting inflation back to 2% or just nothing that will distort any behaviors out there. We are not there right now.
And Diane, that was beautifully explained. I mean, this really, folks, goes to the asymmetric regret looking back that any central bank has. What's fascinating to me, Diane, is the idea that they're going to overshoot in some way, waiting and waiting for 2%. Do you see a Fed that out in 24 or 25 is going to begin to amend a band around 2% and migrate that to a higher level?
They could down the road. They won't do it until this war on inflation is won. I will never forget Neil Kashkari and his comments at Jackson Hole saying, we're not going to go to 3% and set that as a target in the middle of a raging inferno. What he meant by that is the Fed cannot move the finish line when they're battling inflation. They've got to cross that finish line. And when they come back and reassess what is the appropriate inflation rate, after the last time they assessed what the appropriate decision rules were, they could come back and raise it, but I don't think it's going to be as soon as many people think because of how long they think it's actually going to take to get inflation down to 2%.
Michael, your shop has such a handle on America. I mean, there's just no other way to put it. It's the heritage of the bank. How close are we to economic slowdown? If there's parts of America, 2, 3, 4 Americas, what portion of America is actually feeling recession now?
A third, maybe. I mean, we see it certainly in housing and some of the non-residential business spending data. We're seeing it in the manufacturing data, but in the consumer growth in consumer spending has slowed. But you don't get recessions in the U.S. if the consumer continues to spend at roughly a 2% rate, and that's what they did over the past year. To take some of these pressures out of the labor market, you probably need to slow that more. The January data on spending, our proprietary card data that we look at shows actually a pretty decent bounce in spending in January, reversing some of what we thought was a seasonal weakness in December. You've got increases, cost of living increases for Social Security, the readjustment of tax brackets, the increase in federal employment salaries that kick in. So we're likely to have kind of a one-time increase in income and spending here in January that leaves us with pretty good momentum.
Mike, there is this line in the statement. Let's work through it together. It says the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation. We had this conversation with Rich Clarida about 15 minutes ago. What lags, Mike? Just how long are those long and variable lags?
The standard rules, I think, as Rich was alluding to, but he didn't say quite this way. 12 to 18 months is about how long it takes the cumulative effect of policy to bake in. So yeah, some of it gets baked in faster. The interest rate sensitive sectors are slowing. I kind of think the remainder of it is still in front of us. We do think the consumer will face more headwinds as the year progresses. So something in the second or third quarter might be when most of the weight of prior tightening shows up in consumer spending. So I don't think we're there yet.
You'll excuse me for being somewhat impatient, Dan, but if you'd asked me back in August whether claims would be at 186,000 at this meeting, I would have said no, probably not, and they'd be going in the other direction. So is there anything to learn from that?
It's really been amazing how stunningly strong the labor market is, and that's why the Fed has it in their target. And I think that's what's so hard about where the Fed is standing right now, but they certainly are not willing to back down. The fact that the labor market is where demand and supply is now the most out of line is important. We're talking about 1.9 job openings per job seeker in the month of December. That's close to the record highs that we saw in 2022 when wages were accelerating. Also important is that 8.7% increase in Social Security that Mike mentioned. That's really important because that's $8.9 billion in cash that 66 million at least consumers got in January alone. That is a very important amount of cash that is all likely to be spent. And from the spending data that he just mentioned, they are spending it. That is likely to be on services and necessities and put, again, an additional reacceleration in inflation in play. And that's what the Fed is worried about.
We're looking at markets that initially sold off, that stocks sold off. Bonds did as well in response to the statement. The NASDAQ has reversed, interestingly, as people parse through this, which, John, I actually find pretty interesting. It's sort of the market wants to go up regardless. It was, multiple hikes, whatever. Okay, let's go up. Things are good.
There's a lesson every time the Fed meets. It's never spin too much of a story just before the news conference starts. It's kind of like the earnings reports, right? The earnings come out, you wait for the call and the guidance, and I think on Fed Day, Tom, it's kind of the story with the Fed too. You get the statement, okay, hands off. Let's see what the chairman's got to say in 18
You nailed it. We're addicted to the guidance, and in the defense of everyone, why aren't they giving us guidance every meeting? I mean, it can be lesser guidance, I get that, but there's sort of a vacuum here to move on. I'm sorry, I don't have these memorized, John. I'm trying to. I took a quiz and flunked. March 22nd, May 3rd. When does this get important again? I don't have an answer.
So if we had the
June
statement
14?
today, Tom, alongside a summary of economic projections, Dan, I think this is a question for you. Dan, if we had that SEP today, how do you think it would evolve relative to what we got in December?
Good question.
I actually don't think it would change as much as people think. We have those doves rotating in. We had a lot of people talking about maybe a pause in rates. Patrick Harker, who's a voting member of the Fed now, Lori Logan from the Dallas Fed is a voting member, Austin Goolsbee is now a voting member of the FOMC at this meeting as well from the Chicago Fed. All new voting members, Neil Kashkari now on the other side, who used to be a dove, now very hawkish. I think it's really important to understand that the data we've just gotten in the last couple of days actually hardens the Fed's resolve. And Chairman Powell went out of his way to say that there was no one who had a rate cut priced in December in the SEP when he talked about it. Now, Chairman Powell doesn't really love the SEP. It's something that's been sort of a thorn in his side at times. But I think that was very important guidance that he gave, that no one had a rate cut for 2023. The Fed really wants to hammer that point in. And even though we have some doves on the Fed, they're going to be relooking at the data that's just come in and say, you know what? We should stick to where we are. Stay the course is what we heard over and over again. This is going to be a very hawkish description of that meeting. And I don't think there's as much debate as many people thought was emerging. I think that just got quelched by the data we've seen.
And Mike Apen, your thoughts?
So I would agree. I don't think the SEP would have changed all that much. I think the terminal rate projection and median would be about the same. I'll just make a point, though, in this regard. You can be hawkish in what you do. You can be hawkish in what you say. After slowing down for the second straight meeting to 25 basis points, it's going to be really hard to change the effect of that, right? So if they really, really wanted to push back against expectations of easing in financial conditions or cuts later, or just if they wanted to kind of, reassert their intent, they could have gone 50 and they didn't. So there's not a lot, I think, that you can talk about at this point without another forecast, to really kind of change what markets think. Markets know you slowed down again. So it's a dovish meeting on net relative to where the committee was just a month or two ago.
If it's a dovish meeting, Michael, and it was nice of you to arrange for CPI Wednesday or whatever it is to be Valentine's Day. Did you know that, John?
I didn't know that.
CPI is Valentine's Day. Michael Gapin, what if we get a disinflationary tinged February 14th CPI day? What does that do to our world?
Well, it reinforces the view that we're past peak inflation. It probably means it's easier for the Fed to accept that inflation's moving lower. And it would reinforce the view of the minds of markets that the Fed could be cutting later this year. So the faster inflation dissipates, then the Fed's at risk of its policy rate getting too tight, right? So there's some probability that you'll get cuts later this year. So I think it would reinforce the narrative.
Dan, you have an understanding of the Midwest of this nation like really no one we speak to. And I want to go to the great Jim Glassman at J.P. Morgan, who is heated in his commercial banking meetings of the optimism of America. I looked at a zip code in Kansas a couple days ago on a Blackstone thing, and the unemployment rate is 2.2% in Kansas. Is the East Coast, are the elites like Lisa Abramowitz overwrought about all this while America booms?
Certainly we are.
Sorry, go ahead, Diane.
I was just going to say on the Midwest, it's really interesting to see the job opening data today in some of the states that are seeing declines in openings like Texas. Related to the tech sector, their job openings actually declined. Florida's still strong, but actually much of the job openings that we saw accelerate were in the Midwest, including Illinois, Wisconsin, Iowa. That's important. That's been a shift that we've seen. And talking to the automakers and OEMs, what we're hearing out there is that although they'd like to ramp up, they're worried about affordability on vehicles. And even though they'd like to ramp up as China reopens and they get more chips, they also just don't have the workers to do it. And they're going into UAW contracts in June, and aren't running third shifts right now. And that's important because labor is a constraint to them. That is something we have to watch very carefully.
Diane, just quickly, we usually give you the opportunity to pose a question for Chairman Powell. Can we wrap things up by doing that? Your thoughts going into this one?
I think they need to ask them yet again, what role do financial markets play in their decision making? How do they want to push back against financial markets? And I actually disagree. I think they can go ahead and go 50 if they actually felt like the situation was deteriorating and inflation was accelerating again. This is a Fed that's shown its willingness to do a U-turn and do it aggressively. I would not underestimate their commitment to doing that again if they felt it need be.
Mike Gapin, final word. Same question to you, sir.
Well, so I'll refer back to what I said earlier. Is it on the table that balance sheet runoff can continue even if you're cutting rates? So can you mix your instruments in a different way to keep financial conditions tighter for longer?
Mike Gapin, Diane Swung, to the both of you, thank you. If you are just tuning in, we are 12 minutes away from a news conference with Chairman Powell after the Federal Reserve chose to hike interest rates 25 basis points, another downshift. We're looking for some form of, wait for this, Tom, you'll love this phrase, hawkish downshift.
Oh, you're killing me.
When you go from 50 to 25 and push back against market pricing for rate cuts.
Every guest that we have is different. And Diane Swang from Bank One a few years back, working for Mr. Diamond when nobody knew who he was. And the bottom line is, John, there's a labor fabric here, and that is, El Arian talks about the unknown unknown.
Sure.
The unknown unknown right now is the American labor economy. And it looks like to me, away from the tech, overhiring and that, it's a job-making machine. She just said that there. And the underlying is Amazon and $17 an hour. That's changed the entire dialogue of labor in this country.
Totally agree. If you're looking to the statement this afternoon from the Federal Reserve, that line is still in there. The committee anticipates that ongoing increases in the target range will be appropriate. The market response, Lisa picked up on this, down, back up, down again. We're down 0.4% on the S&P, the Nasdaq largely unchanged. At the front end of the yield curve, the two-year yield just a little bit higher by 3 basis points on a 2-year to 4.22. You can call it 4.23 On a 10-year, we move lower to 348, so the curve a little bit more inverted, negative 74 basis points, the 2s-10s curve right now. I'm pleased to say that joining us is Greg Davis, the Vanguard CIO, waiting patiently. Greg, fantastic to catch up with you, sir. It's been too long. We are about 10 minutes away from this news conference. Greg, can I just get your first thoughts on that statement from this Fed about 20 minutes ago?
That statement was in line with what we were thinking in terms of, going 25 basis points this meeting, and then the need to do ongoing increases is pretty much what our economics team is forecasting for the Fed to go to a 5.25 type rate over time.
Greg, you've got a wonderful John Bogle view on your Vanguard note that if you miss the 30 best days going back a few years to 1928, you're wiped out. You don't get to play. How do our viewers and listeners get to play given the cacophony and noise of a Fed?
It's a great question, Tom. The reality is what we say to our investors is that they need to stay fully invested at all times. And the point of that note was really the fact that if you miss the 30 best days, you're ultimately going to reduce 50% of your long-term returns. And we know it's unbelievably hard for investors to time markets. So for those investors, we just tell them to focus on the things that they can control, balance diversification, making sure they're investing in funds that offer low fees to make sure they retain the majority of their earnings in the marketplace.
The heart of the problem here, and it's something Vanguard and others are known for, is you got to be in the market. And the basic feeling here is things are going to fall apart in a 78, 79 pre-Volcker way. We've ebbed away from that with a spectacular January. What does this Fed need to do to relink with a market that's moving away from their theories and policy?
Well, I think there's a couple of things. One, it boils down to fundamentals, and we know that the Federal Reserve is trying to get inflation under control, and they're doing a great job at that. When we think about how we're looking at the economy going forward for the remainder of this year, we're seeing inflation come down to 3%, around that range at the end of this year. But that last mile, trying to counsel our clients on, is the fact that don't leave money sitting in a bank account where it's earning 30 basis points at max, where you can sit there and invest in a money market fund where you're earning 4.3% or so.
Yeah.
That's real money.
We were talking about the market response to this somewhat, some would say hawkish, some would say in actuality dovish statement. There was a comment out on Twitter by an FX trader basically saying, right now, words mean very little from the Federal Reserve. Bonds know this, that the market basically is looking past anything the Fed will say. Is there anything that Fed Chair Jay Powell could say in, say, 8 minutes time that will catch your attention, that will make you shift your view?
I think a big part of it is really how he's thinking about the market more broadly. And when we look at financial conditions and the fact that they've eased up so much over the course of the last 6 months or so, if he were to come in and say something more aggressively than what the market's expecting. So again, our view is that there's going to be a couple more rate hikes, which is in line with the language. But if he were to say, the market is way off base, I don't think that's going to necessarily be perceived well by the equity markets, which in our view still seem a bit stretched from our perspective.
So that's actually what I was going to ask next. Do you think that the equity markets have fully priced in a rate regime in the 4% handle, even 3.5%? Or are they still kind of working through the hangover of zero rates?
It feels to us that there's a lot of good news that's still being priced into the equity markets. I mean, when we look at our Vanguard Capital Markets model, our projected returns over the next decade for U.S. equities is somewhere in the range of about 5.5%. When you look at U.S. bonds, our expected returns over the next decade is about 4.5%. And there's a clear difference when it comes to volatility between those two sectors, with bonds having about a third of the volatility that you'd find in the equity market. So, on a risk-adjusted basis, bonds look really attractive for investors. But what we'd say is that making sure that you have balance and diversification in your portfolio is going to be critically important. And bonds are going to serve a much greater role providing diversification benefits than they have over the last number of years, just given that rates were suppressed.
Greg, let's nail you down on this. In a treasury market, we've heard it a few times, that it's the year of fixed income, the year of bonds. Is there any way that could go wrong in a treasury market? What would that look like?
The thing that could go wrong there, Jonathan, and I appreciate the question, is really whether or not inflation ends up being unhinged and ends up not coming down the way we forecast. Now, if we got into a place where inflation was really elevated at 4 or 5%, and it wouldn't come down to that 3 or 2% over time, that would be problematic to the bond market.
Greg Davis there at Vanguard. Greg, this was wonderful to catch up with you, sir. Again, it has been too long. Thank you very much. Your equity market then, down about 0.4% on the S&P 500. Your bond market selling off a little bit at the front end. So yields higher on a 2-year by 3 basis points to 4.23. On a 10-year down 2 basis points to 3.48. 2-year yield higher, 10-year yield lower. That means the difference between the two gets wider. The curve a little bit more inverted, negative 74. The difference between the two, that widens by about 5 basis points actually. So that's the price action in the bond market. If you are just tuning in, about 25 minutes ago, the Federal Reserve hiking interest rates 25 basis points. There was a big fascination, obsession almost with the statement and whether this phrase ongoing increases would remain in the statement. Tom, it did. The committee anticipates that ongoing increases in the target range will be appropriate, but how much further are they going to go? And that's the mystery for the rest of this year as the gap between the Federal Reserve and this market persists.
Maybe it's the mystery of the press conference. I love what Chris Lowe writes up at FHN is this is, it's an important statement and all that, and the story's driven forward. But this press conference becomes where every nuance of it really matters because I didn't get much out of the statement. So to me,
no real change this time.
Yeah, the press conference coming up, possibly with McKee's rude questions, plural,
as always,
will be, it could be market moving.
Lisa and I have discussed this through today. In fact, we all have over the last couple of weeks. We know in this news conference, which starts in about 4 minutes, the chairman is going to be asked about the easing of financial conditions. We had a conversation with Rich Clarida, the former Fed vice chair, about 30 minutes ago and asked him how the chairman would tackle that question. I have to say he was pretty nuanced about it. Lisa, he didn't say you'd get this full emphatic pushback by the Fed chair. Now let's assume you do get one though. Let's say he pushes back. The mystery to me is how the market responds to it.
Especially because they didn't raise rates by 50 basis points as they could have. And this to me was the key comment from Michael Gapin at Bank of America. This is a hawkish statement, but the action is dovish. They could have gone 50, they didn't. And that's what markets are responding to. If they do a full-throated pushback of the markets, why didn't they then go 50?
We're watching what they do, Tom, not what they say. And clearly they've been stepping down over the last couple of meetings.
Yeah, absolutely. But watch what they do is they're going to look at the data. And it's the first time we've really talked about it. I'm sorry, one inflation report, another inflation report, a third inflation report, and that gets you out to February 14th. And I'm sorry, it could be a complete change off of jobs that we don't, do I look at ADP today as a legitimate number? No, I can't. I could be wrong.
Are JOLTS legitimate? People are asking that too.
Yeah, I think JOLTS are more proven than ADP.
There is clearly a tug of war right now. Doesn't seem to be able to overcome the financial conditions paradox. With such conditions already looser than when the Fed started its hiking cycle, markets took virtually no time to shake off the initial negative price action due to the more hawkish language. Lisa, it's words versus action.
And that really is the verdict right now. Action trumps words. And the market's going to look for the action, and that's the entirety of it. And yes, they're going to watch the data, but ultimately, Fed Chair Jay Powell can say whatever he wants. I don't know what can get the market's attention right now.
I got 6 seconds because Powell's always on time. Guess what? I'm going to go to the American philosopher Neil Dutta. It's a pretty good economy.
You saw what Neil said this morning in that message to me. Housing's picking up again. Global growth is picking up. The IMF. I've never seen an economist on Wall Street bring up an IMF forecast in the way that Neil has, but we'll let that one go. The IMF just revised up their growth forecast. Where is the evidence that the unemployment rate is going to go up that much? Claims are plumbing new debts. We get claims tomorrow?
Yeah.
Tomorrow morning?
Tomorrow morning.
186,000 last week.
We aren't seeing it in the claims. We aren't seeing it in the jobs creation because it's supposed to be south of 100,000 for a couple consecutive months in order to get to the unemployment rate that people are looking for.
Chairman Powell walking in after hiking interest rates 25 basis points. Here's the chairman of the Federal Reserve.
And welcome. My colleagues and I understand the hardship that high inflation is causing, and we are strongly committed to bringing inflation back down to our 2% goal. Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by 25 basis points. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive stance for some time. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 1%. Recent indicators point to modest growth of spending and production this quarter. Consumer spending appears to be expanding at a subdued pace, in part reflecting tighter financial conditions over the past year. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 247,000 jobs per month over the last 3 months. Although the pace of job gains has slowed over the course of the past year and nominal wage growth has shown some signs of easing, the labor market continues to be out of balance. Labor demand substantially exceeds the supply of available workers, and the labor force participation rate has changed little from a year ago. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in December, total PCE prices rose 5.0%. Excluding the volatile food and energy categories, core PCE prices rose 4.4%. The inflation data received over the past 3 months show a welcome reduction in the monthly pace of increases. And while recent developments are encouraging, we will need substantially more evidence to be confident that inflation is on a sustained downward path. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that's not grounds for complacency. Although inflation has moderated recently, it remains too high. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 20.
We've helped millions of creators improve their SEO to grow their YouTube channels. TubeBuddy is a platform that
the size of our balance sheet. With today's action, we have raised interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy, particularly housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 25 basis points today, continuing the step down from last year's rapid pace of increases. Shifting to a slower pace will better allow the committee to assess the economy's progress toward our goals, as we determine the extent of future increases that will be required to attain a sufficiently restrictive stance. We will continue to make our decisions meeting by meeting, taking into account the totality of incoming data and their implications for the outlook for economic activity and inflation. We have been taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Chris Rugaber, the Associated Press. Thank you for doing this. As you know, financial conditions have loosened since the fall, with bond yields falling, which has also brought down mortgage rates, and the stock market posted a solid gain in January. Does that make your job of combating inflation harder? And could you see lifting rates higher than you otherwise would to offset the increase in, or to offset the easing of financial conditions?
So it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place in order to bring inflation down to 2%. And of course, financial conditions have tightened very significantly over the past year. I would say that our focus is not on short-term moves, but on sustained changes to broader financial conditions. And it is our judgment that we're not yet at a sufficiently restrictive policy stance, which is why we say that we expect ongoing hikes will be appropriate. Of course, many things affect financial conditions, not just our policy. And we will take into account overall financial conditions along with many other factors as we set policy.
Rachel. Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. Over the last quarter, we've seen a deceleration in prices, in wages, and a fall in consumer spending, all while the unemployment rate has been able to stay at a historic low. Does this at all change your view of how much the unemployment rate would need to go up, if at all, to see inflation come down to the levels you're looking for?
So I would say it is a good thing that the disinflation that we have seen so far has not come at the expense of a weaker labor market. But I would also say that disinflationary process that you now see underway is really at an early stage. What you see is really in the goods sector, you see inflation now coming down because supply chains have been fixed, demand is shifting back to services, and shortages have been abated. So you see that in the housing services sector. We expect inflation to continue moving up for a while, but then to come down, assuming that new leases continue to be lower. So in those two sectors, you've got a good story. The issue is that we have a large sector called non-housing service, core non-housing services, where we don't see disinflation yet. But I would say that so far, what we see is progress, but without any weakening in labor market conditions. Go ahead.
Has your expectation for where the unemployment rate might go changed since December?
You know, we're going to write down new forecasts at the March meeting, and we'll see at that time. I will say that it is gratifying to see the disinflationary process.
In the December jolts this morning, job openings actually rising. That also has coincided with slowdown in wage inflation. Do you believe that openings are an important indicator to be studying to understand where the labor market is and where wage inflation might be heading?
So you're right about the data, of course. What we did see, we've seen average hourly earnings and now the employment cost index abating a little bit, still off of their highs of 6 months ago and more, but still at levels that are fairly elevated. The job openings number in jolts has been quite volatile recently, and I did see that it moved back up this morning. I do think that it's probably an important indicator. The ratio, I guess, is back up to 1.9 job openings to unemployed people who are looking for work. So it's an indicator, but nonetheless, you're right. We do see wages moving down. If you look across the rest of the labor market, you still see very high payroll job creation, and quits are still at an elevated level. So by many indicators, the job market is still very strong.
Colby and then Howard. Thank you. Colby Smith with the Financial Times. Given the economic data since the December meeting, is the trajectory for the Fed funds rate in the most recent SEP still the best guidepost for the policy path forward? Or does ongoing now mean more than 2 rate rises now?
So you're right. At the December meeting, we all wrote down our best estimates of what we thought the ultimate level would be, and that's obviously back in December, and the median for that was between 5 and 5.25%. At the March meeting, we're going to update those assessments. We did not update them today. We did, however, continue to say that we believe ongoing rate hikes will be appropriate to attain a sufficiently restrictive stance of policy to bring inflation back down to 2%. We think we've covered a lot of ground, and financial conditions have certainly tightened. I would say we still think there's work to do there. We haven't made a decision on exactly where that will be. I think we're going to be looking carefully at the incoming data between now and the March meeting and then the May meeting. I don't feel a lot of certainty about where that will be. It could certainly be higher than we're writing down right now. If we come to the view that we need to write down to move rates up beyond what we said in December, we would certainly do that. At the same time, if the data come in the other direction, then we'll make data-dependent decisions at coming meetings, of course.
Just as a quick follow-up, how are you viewing the kind of balance of risk between those two options of, the likelihood of maybe falling short of that or going beyond that level?
I guess I would say it this way. I continue to think that it's very difficult to manage the risk of doing too little and finding out in 6 or 12 months that we actually were close but didn't get the job done, and inflation springs back and we have to go back in, and now you really do worry about expectations getting unanchored and that kind of thing. This is a very difficult risk to manage, whereas of course we have no incentive and no desire to over-tighten, but if we feel like we've gone too far, we can certainly and inflation is coming down faster than we expect, then we have tools that would work on that. So I do think that in this situation where we have still the highest inflation in 40 years, the job is not fully done. As I started to mention earlier, we have a sector that represents 56% of the core inflation index where we don't see disinflation yet. So we don't see it. It's not happening yet. Inflation in core services ex housing is still running at 4% on a 6 and 12-month basis. So there's nothing happening there. In the other two sectors, representing less than 50%, you actually, I think, now have a story that is credible, that's coming together. Although you don't actually see disinflation yet in housing services, but it's in the pipeline, right? So for the third sector, we don't see anything here. So I think it would be premature. It would be very premature to declare victory or to think that we've really got this. We need to see. Our goal, of course, is to bring inflation down. And how do we get that done? There are many factors driving inflation in that sector, and they should be coming into play to have inflation, the disinflationary process, begin in that sector. But so far, we don't see that. And I think until we do, we see ourselves as having a lot of work left to do.
Howard Schneider with Reuters, and thanks as usual. So I just wanted to connect a couple dots here. The statement's made a number of changes that seem to be saying things are getting better. You're saying inflation has eased. That's new. You've taken out references to the war in Ukraine as causing price increases. You've taken out references to the pandemic. You've eliminated all the reasons that you said prices were being driven higher, yet that's not mapping to any change in how you describe policy. We still have ongoing increases to come. So I'm wondering, why is that the case? And does it have more to do with uncertainty around the outlook, or more to do with you not wanting to give a very overeager market a reason to get ahead of itself and overreact?
So I guess I would say it this way. We can now say, I think, for the first time, that the disinflationary process has started. We can see that, and we see it really in goods prices so far. Goods prices is a big sector. This is what we thought would happen since the very beginning, and now here it is actually happening, and for the reasons we thought. It's supply chains, it's shortages, and it's demand revolving back towards services. So this is a good thing. This is a good thing. But that's, around a quarter of the PCE price index, core PCE price index. So the second sector is housing services, and that's driven by very different things. And we, as I mentioned, with housing services, we expect, and other forecasters expect, that measured inflation will continue moving up for several months, but will then come down, assuming that new leases continue to be soft. And we do assume that. So we think that that's sort of in the pipeline. And inflation in the goods sector, and we see it in the pipeline for two sectors that amount to a little less than half. So this is good, and we note that when we say inflation is coming down, this is good. We expect to see that disinflation process will be seen, we hope soon, in the core goods ex-housing, the core services ex-housing sector that I talked about. We don't see it yet. It's 7 or 8 different kinds of services. Not all of them are the same, and we have a sense of what's going on in each of those different subsections. Probably the biggest part of it, probably 60% of that is. Research would show is sensitive to slack in the economy, and so the labor market will probably be important. Some of the other ones, the labor market's not going to be important. Many other factors will drive it. In any case, we don't see disinflation in that sector yet, and I think we need to see that. It's the majority of the core PCE index, which is the thing that we think is the best predictor of headline PCE, which is our mandate. So it's not that we're neither optimistic nor pessimistic. We're just telling you that we don't see inflation moving down yet in that large sector. I think we will fairly soon, but we don't see it yet. Until we do, I think we see ourselves, we got to be honest with ourselves, we see ourselves as having perhaps more persistent inflation in that sector, which will take longer to get down. And we're just going to have to complete the job. I mean, that's what we're here for.
Nick Timmeros, the Wall Street Journal. Chair Powell, you observed several years ago that we learned we can have a low unemployment rate without above target inflation, and we have learned lately that inflation can come down from its uncomfortably high level despite a historically low unemployment rate. Given that, and given how much you did over the last year, why do you think further rate increases are needed? Why not stop here and see what transpires in the coming months before raising rates again?
So we've raised rates 4.5 percentage points, and we're talking about a couple of more rate hikes to get to that level we think is appropriately restrictive. And why do we think that's probably necessary? We think because inflation is still running very hot. We're, of course, taking into account long and variable lags, and we're thinking about that. The story we're telling about inflation is, to ourselves, and the way we understand it is basically the three things that I've just gone through a couple times. And again, we don't see it affecting the services sector ex-housing yet. But I mean, I think our assessment is that we're not very far from that level. We don't know that, though. We don't know that. So I think we're living in a world of significant uncertainty. I would look across the spectrum of rates and see that real rates are now positive, right by an appropriate set of measures are positive across the yield curve. I think policy is restrictive. We're trying to make a fine judgment about how much is restrictive enough. That's all. And we're going to, that's why we're slowing down to 25 basis points. We're going to be carefully watching the economy and watching inflation and watching the progress of the disinflationary process.
Did you or your colleagues discuss the conditions for a pause at this meeting this week?
You'll see the minutes will come out in 3 weeks, and we'll give you a lot of detail. We spent a lot of time talking about the path ahead and the state of the economy, and I wouldn't want to start to describe all the details there, but that was the sense of the discussion, was really talking quite a bit about the path forward.
Victoria.
Hi, Chair Powell. I wanted to ask about the debt ceiling. Given that we've now hit up against it, I was wondering if the U.S. goes past the X date, will the Fed do whatever the Treasury directs as it relates to making payments as the fiscal agent, or will it do its own analysis of any legal constraints?
So your question is, say your question again?
Will the Fed do what Treasury directs as it relates to making payments, or will it do its own analysis of any legal constraints?
So you're really asking about, you're asking about prioritization in effect, is what
yes,
you're, okay.
Yes.
So I feel like I have to say this. There's only one way forward here, and that is for Congress to raise the debt ceiling so that the United States government can pay all of its obligations when due. And any deviations from that path would be highly risky, and that no one should assume that the Fed can protect the economy from the consequences of failing to act in a timely manner. In terms of our relationship with the Treasury, we are their fiscal agent, and I'm just going to leave it at that.
Are you actively doing any planning of what might happen in the event that would happen?
I'm just going to leave it at that. This is a matter that's to be resolved between, it's really Congress's job to raise the debt ceiling, and I gather there are discussions happening, but they don't involve us. We're not involved in those discussions, so we're the fiscal agent.
Gina and then Steve.
Gina Smiley from the New York Times. Thanks for taking our questions. I wonder, was there any discussion today of the possibility of pausing rate increases and then restarting them? Lori Logan from the Federal Reserve Bank of Dallas seemed to suggest that would be a possibility in a recent speech, and I wonder if that view is broadly shared on the committee.
So the committee, obviously, did not see this as a time to pause. We judged that the appropriate thing to do at this meeting was to raise the federal funds rate by 25 basis points, and we said that we continue to anticipate that ongoing increases in the target range will be appropriate in order to attain that stance of sufficiently restrictive monetary policy that will bring inflation down to 2%. So that's the judgment that we made. We're gonna write down new forecasts in March, and we'll certainly be looking at the incoming data as everyone else will.
Sorry, I should have been clear. I mean, would it be possible to take a meeting off, for example, and then resume? Could you, rather than just doing at every meeting a move, go a little bit more slowly, take some gaps in between moves?
I mean, I think this is not something that the committee is thinking about or exploring in any kind of detail. In principle, though, we used to do was go every other meeting, if you remember, 25 basis points, and that was considered a fast pace. So I think a lot of options are available, and you saw what the Bank of Canada did, and they left it that they're willing to raise rates after pausing. But this is not something that the Federal Open Market Committee is on the point of deciding right now.
Steve Leisman, CNBC. Mr. Chairman, the SEP has the PCE inflation rate in 2023 at 3.1%. Meanwhile, the 3-month annualized PCE is 2.1%, and you've achieved this without going to your 5.1% funds rate, which is what you have penciled in for this year. And you've also achieved it without the 1 percentage point increase in the unemployment rate, which you have penciled in for this year. I'm wondering if you've considered the idea of whether or not your understanding of the inflation dynamic may be wrong, and it's possible to achieve these things without raising rates that high, and also without the surge in unemployment. And specifically, I wonder if you might comment on the speech given by Vice Chair Lel Brainerd, who said, to the extent that inputs other than wages may have been responsible in part for important price increases for some non-housing services, an unwinding of these factors. In other words, it may not be wages, the idea that it may not require unemployment rising to get this sector of inflation under control. Thanks.
So a couple things. First, on the on the forecast, you're right. If you take very short-term, three month say measures of PCE, core PCE inflation, they're quite low right now. But that's because that's driven by significantly negative readings from goods inflation. Most forecasters would think that the significantly negative readings will be transitory, and that goods inflation will move up fairly soon back up to its longer run trend of something around zero, something like that. So a lot of forecasts would call for core PCE to go back up to 4% by the middle of the year, for example. So that's really where the sustainable level is more like at 4%. So that would suggest there's work left to do. Let's say inflation does come down much faster than we expect, which is possible. As I mentioned, obviously our policy is data dependent. We would take that into account. In terms of the core non-housing services, as I mentioned earlier, it's a very diverse sector, 6 or 7 sectors, and so sectors that represent 55 or 60% of that subsectors of that sector we think are sensitive to slack in the economy, sensitive to the labor market in a way. But some of the other sectors are not. And for example, financial services is a big sector. That's really not driven by labor markets, wages. So that's why I said there are a number of things that will affect. Take restaurants, right? So clearly labor is important for restaurants, but so are food prices. And transportation services is going to be driven by fuel prices, for example. So there are lots of things in that mix that will drive inflation. I would say overall, though, my own view would be that you're not going to have a sustainable return to 2% inflation in that sector without a better balance in the labor market. And I don't know what that will require in terms of increased unemployment, your question. I do think there are a number of dimensions through which the labor market can soften, and so far we've got, as I mentioned, in goods we have inflation moving down without the softening in the labor market. I think most forecasters would say that unemployment will probably rise a bit from here, but I continue to think that there's a path to getting inflation back down to 2% without a really significant economic decline or a significant increase in unemployment. And that's because the setting we're in is quite different. The inflation that we originally got was very much a collision between very strong demand and hard supply constraints, not something that you really have seen in prior business cycles. And so now we see goods inflation coming down for the reasons we thought, and we understand why housing inflation will come down. And I think a story will emerge on the non-housing services sector soon enough, but I think there's ongoing disinflation, and we don't yet see weakening in the labor market. So we'll have to see.
Can we get there with 5%?
Certainly possible. Yeah, absolutely, it's possible. It's a question no one really knows. I think it's because this is not like the other business cycles in so many ways. It may well be that that it will take more slowing than I expect to get inflation down to 2%. But I don't. That's not my base case. My base case is that the economy can return to 2% inflation without a really significant downturn or a really big increase in unemployment. I think that's a possible outcome. I think many forecasters would say it's not the most likely outcome, but I would say there's a chance of it.
Michael. Michael McKee from Bloomberg TV and Radio. I'd like to pick up on what you were just saying about a substantial downturn and ask, with the full weight of your tightening not in place yet, and with the progress against inflation, there's still a lot of talk about very, very slow growth going forward in 2023. And the recession indicators are all suggesting that we are going to see recession this year. So I'm wondering if you've changed your view, or you have a more nuanced view of what you think the danger to economic growth is going forward, and whether you're very close to perhaps tipping it into the wrong place, which calls for more restraint on your part.
So I do think most forecasts and my own assessment would be that growth will continue, positive growth will continue, but at a subdued pace, as it did last year. We had growth of GDP growth of 1% last year, and also final sales growth, which we think is a better indicator of about 1%. I think most forecasts and certainly my assessment would be that growth will continue at a fairly subdued level this year. There are other factors, though, that need to be considered. You will have seen that the global picture is improving a bit, and that will matter for us potentially. The labor market remains very, very strong, and that's job creation, that's wages. As inflation does come down, sentiment will improve. You also, state and local governments are really flush these days with money, and many of them are considering tax cuts or even sending checks. So I think that's going to support. They're also spending a lot. There's a lot of spending coming in the construction pipeline, both private and public, and so that's going to support economic activity. So I think there's a good chance that those factors will help support positive growth this year. And that's my base case is that there will be positive growth this year.
Thank you. Rich Miller from Bloomberg. First of all, how are you doing?
Fine, thanks. Fine.
Good. Second off, I think earlier on in the press conference you said you need to see substantially more evidence of inflation coming down. Can you give us some idea of what you're thinking of? You mentioned 3 months, that we've seen 3 months in a row. Governor Walters suggested he might want to see 6 months. Is it just the inflation data, or do you have to see the labor market coming back into better balance to have that substantially more evidence
So I don't think there's going to be a light switch flipped or anything like that. I think it's just an accumulation of evidence. So of course we'll be looking, by the time of the March meeting, we'll have 2 more employment reports, 2 more CPI reports, and we'll be looking at those carefully, as all of us will, and we'll be asking ourselves, what are they telling us? And soon after that, we'll have another ECI wage report, which, as you know, is a report that we like because it adjusts for composition and it's very complete. And the one we got, I guess it was yesterday, was constructive. It shows wages coming down, but still at a high level. They're still at a level that's well above where they were before the pandemic. So I don't want to put a number on it in terms of months, but as the accumulated evidence comes in, it's going to be reflected in our assessment of the outlook, and that will be reflected in our policy over time. But I will say, though, it is our job to restore price stability and achieve 2% inflation for the benefit of the American public. Market participants have a very different job. And it's a fine job. It's a great job. I did that job for years, but in one form or another. But we have to deliver that, and so we are strongly resolved that we will, complete this task because we think it has benefits that will, support economic activity and benefit the public for many, many years.
Thank you, Michelle. Thank you, Fed Chairman, for taking the questions. So you've talked about we had solid job growth. I'm Edward Lawrence from Fox Business, by the way. We had solid job growth, a slight falling in the increase in consumer spending. It seems so far it's been relatively mild from the economy to go from a 9.1% CPI inflation to 6.5% CPI inflation. Is the hard part yet to come, to go from 6.5 to 2?
I don't think we know, honestly. So we, of course, expected goods inflation to start coming down by the end of 2021. And it didn't. It didn't come down all through 22, and now it's coming down, and it's coming down pretty fast. So I would say this is not a standard business cycle where you can look at the last 10 times there was a global pandemic and we shut the economy down, and Congress did what it did and we did what we did. It's unique. So I think certainty is just not appropriate here. Inflation, it's just harder to forecast inflation. It may come down faster. It may take longer to come down. And, our job is to deliver inflation back to target, and we will do that. But I think we're going to be cautious about declaring victory and, sending signals that we think that the game is won, because we've got a long way to go. It's the early stages of disinflation, and it's most welcome to be able to say that we are now in disinflation. But that's great. But we just see that it has to spread through the economy and that it's going to take some time. That's all.
How long do you see then the federal funds rate remaining at this elevated level?
My forecast and that of my colleagues, as you will see from the SEP, and there are many different forecasts, but generally it's a forecast of slower growth, some softening in labor market conditions, and inflation moving down steadily, but not quickly. And in that case, if the economy performs broadly in line with those expectations, it will not be appropriate to cut rates this year, to loosen policy this year. Of course, other people have forecasts with inflation coming down much faster. That's a different thing. If that happens, if inflation comes down much faster, then we'll be seeing that, and it will be incorporated into our thinking about policy.
Simon.
Thank you, Chair Powell. Simon Rinovich with The Economist. May I ask a further question about the language around ongoing increases? That, of course, implies at least 2 further rate rises. If you look at Fed Fund futures pricing, the implication is that you'll raise rates one more time and then pause. Are you concerned about that divergence, or do you think if everything breaks right, is that a plausible outcome?
I'm not particularly concerned about the divergence, no, because it is largely due to the market's expectation that inflation will move down more quickly. I think that's the bigger part of that. So again, as I just mentioned, our forecasts, different participants have different forecasts, but generally those forecasts are for continued subdued growth, some softening in the labor market, but not a recession. And we have inflation moving down. Into somewhere in the mid-3s or maybe lower than that this year. We'll update that in March, but that's what we thought in December. Markets are past that. They show inflation coming down in some cases much quicker than that. So we'll just have to see. And we have a different view, it's a different forecast, really. Given our outlook, I don't see us cutting rates this year if we get our outlook turns true. As I mentioned just now, if we do see inflation coming down much more quickly, that'll play into our policy setting, of course.
Hi, Chair Powell. Scott Horsley from NPR. One of the changes in the statement this month is that the committee is no longer listing public health as among the data points you'll consider in assessing conditions. What should we make of that? Does the Federal Reserve no longer see the pandemic as weighing on the economy?
That's the general sense of it. Look, I personally understand well that COVID is still out there, but that it's no longer playing an important role in our economy. And, we kept that statement in there for quite a while, and I think we knew we would take it out at some point. There's never a perfect time. But we thought that, people are handling it better, and the economy and the society are handling it better now. It doesn't really need to be in the Fed's monthly post-meeting statement as an ongoing economic risk, as opposed to, a health issue.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. I wanted to go back to another thing that Fed Vice Chair Lael Brainerd said recently. She said she doesn't see signs of a wage price spiral, and I'm wondering if you agree with that.
People are talking about inflation all day long, every day. The more risk of something like that. But no, there's not much. It's more of a risk. It always has been more of a risk than anything else. By the way, I think it's becoming less salient, and people are, we pick that up in conversations, and I've seen some data too that show people are gradually, they're glad that inflation's coming down. People really don't like inflation. And as we see it coming down, that could also add a boost to economic activity. You look at the sentiment surveys now, and they're very, very low. With 3.5% unemployment and high wage increases nominally by historical standards, why can that be? It has to be inflation, right? So I think once inflation is seen to be coming down in coming months, even you will also see a boost to sentiment, I hope.
So that's what you're looking at most closely is consumer expectations.
That's at the very heart. It's consumers and businesses. Essentially, we believe that expectations of future inflation are a very important part of the process of creating inflation. That's a sort of a bedrock belief. In one way or another, it has to be. We think it's important. And in this case, I would say the risk 8 months ago or so, longer-term inflation expectations had moved up. We moved quite vigorously last year. Expectations seem to be well anchored, including at the shorter end now, not just the longer end. So it's, and I think that's very reassuring. I think, the markets have decided and the public has decided that inflation is going to come back down to 2%, and it's just a matter of us following through. That's immeasurably helpful to the process of getting inflation down. The fact that people now do generally believe that it will come down, that'll be part of the process of getting it down, and it's a very positive thing.
Thank you, Chair Powell. Greg Robb from Market Watch. In the minutes of the December meeting, there was a couple sentences that struck people as important. When the committee said participants talked about this unwarranted easing of financial conditions was a risk, and it would make your life harder to bring inflation down. I haven't heard you talk much about that today or in the statement, so I was wondering, has that concern eased among members, or is that still something you're concerned about? Thank you.
I would put it this way, it's something that we monitor carefully. Financial conditions didn't really change much from the December meeting to now. They mostly went sideways or up and down, but came out in roughly the same place. It's important that the markets do reflect the tightening that we're putting in place. As we've discussed a couple times here, there's a difference in perspective by some market measures on how fast inflation will come down. We're just going to have to see. I'm not going to try to persuade people to have a different forecast, but our forecast is that it will take some time and some patience, and that we'll need to keep rates higher for longer. But we'll see.
Let's go to Brendan for the last question.
Hi, Chair Powell. Brendan Peterson with Punchbowl News. I wanted to ask if the Fed takes into account at all the debt ceiling when it comes to quantitative tightening, given the fact that rapid or
I don't think there's likely to be any important interaction between the two, because I believe Congress will wind up acting, and as it will and must in the end, to raise the debt ceiling in a way that doesn't risk the progress we're making against inflation and the economy and the financial sector. I believe that will happen. I believe it will happen. We of course will monitor money market conditions carefully as the process moves on. For example, the Treasury General account will shrink down and then it will grow back up, and we understand there'll be lots of flows between there and the overnight repo facility and reserves. We understand all that. We're watching it carefully. We'll just be monitoring it. Thank you very much.
That wraps up the news conference with Chairman Powell, a balanced Fed Chair, Jay Powell. I can tell you, the market screaming one thing, and we've got our own view on this. Equities look like this on the S&P 500. Good afternoon to you. This is the Fed Decides. Equities off to the races at 1% on the S&P. On the Nasdaq, up another 2%. Year to date, the Nasdaq 100 is up almost 13 percentage points. In the bond market, big moves. Yields lower on a 2-year by 8 basis points, 4.12% on a 2-year. On a 10-year, down 10 basis points to 340. TK, the Fed chair, says we need to stay restrictive for some time. The job is not fully done. There's a lot of work to do. It's premature to think we've got this. He said if the economy evolves in the way they anticipate, they don't see a 23 rate cut, and yet this market is leaning hard the other way.
We sort of guessed this. It was a snooze statement, up we go, no big deal, and we said maybe the presser will be there, and the presser for a number of minutes was as expected, and then maybe like I've never seen. It's not that we're up, John, it's the way we're up. Out there right now is a massive short cover into some form of dovish outlook.
I just got a message on the Bloomberg. I won't reveal who it is until they give me permission to do so, but I can share the words with you. This is what happens when you don't validate the December dots. That's the view out there on Wall Street at the moment. I would go one step further. In a sense, Lisa, he was recognising that the market was appropriately adjusting to incoming information. And then at times, in fact I would say repeatedly, unconvincingly and unsuccessfully, trying to lean against easy financial conditions simultaneously. Then at the end there, and we talked about this before the decision, he basically said financial conditions hadn't eased too much compared to where they were at the last meeting.
Which is a shocking statement, and I want to just point that out. Mohamed El-Arian putting out and saying, not sure which index he's using. The most widely cited ones show overall financial conditions as loose as they were a year ago. Indeed, the Bloomberg Financial Conditions Index shows the loosest financial conditions going back to February of 2022. So, okay, that's number one. But number two, I would say right out of the gate, the market's got the memo. The first question, just as we said, Jay Powell, are you concerned about how the market has rallied, about how loose financial conditions have become? Immediately, he could have said, yes, this is a huge concern. Instead, it was, I'm not sure.
There's a lot of that, wasn't there?
And then all of a sudden, markets
She did that nicely.
Yeah, that was basically, that's the short version of the news conference. He was asked about whether they discussed the pause. Now, if you want, can you do that sound effect again? Because that would be appropriate. It was kind of, wait for the minutes. Wait for the minutes, TK. TK, what did you make of that? He's asked directly about whether they discussed a pause at this meeting in the last couple of days, and you got nothing back.
You got nothing back. And the whole tenor of it was one of disinflation. I'll let somebody count how many times he said disinflation. John, I actually was thinking, and folks, I can't convey enough the velocities of the market. You're speaking price up, yield down. John, the 2-year yield to 4 digits at one brief second, 4.0981. I was thinking to myself, is this guy going to drive the 2-year under 4% by the end of the conference? If McKee had asked 3 follow-ups, we may have gotten there.
Hey, earlier on this week, we asked, what are you more interested in, the words of Chairman Powell or the economic data? Based on that performance, I'd rather hear from the economic data. Wouldn't you, Lisa?
I mean, basically, what it screams is that he is looking at the disinflation and cautiously optimistic. The idea that he's still talking about a soft landing really highlights just this, saying that, yeah, maybe the balance of risks, hem ha. You've got concerns about perhaps not going far enough, but things look pretty good. Again, this isn't the pushback that people are going to look for in the market.
I like that question on the balance of risk. It came from Colby over at the Financial Times, I think.
Yeah.
Colby Smith. Do you remember Colby?
Yeah, I remember, yeah.
Used to be the class of surveillance so many years ago.
Really?
She asked about the balance of risk, and he kind of danced around it. Maybe 4 months ago, he would have said the risk of doing too little outweighs the risk of doing too much. And then he sort of ummed and ahed. Very difficult to manage the risk of doing too little, and obviously if we do too much, we can do something. But it lacked any real conviction, didn't it?
Okay, so here's the real question. Does he mean what he says? Because if he does mean what he says, why didn't he go 50 and then just pause, right? I mean, in other words, if he really is concerned about financial conditions at any level, then why didn't he do that? And really, that is the screaming conclusion after this press conference.
Yeah, look at the 2.05% NASDAQ lift. You know, the Dow not playing. SPX, I think, is playing out to new highs, 41.18. And I'm thinking of corporations going, okay, we need to buy back shares. And the CEO's on the phone right now screaming, why didn't we do this last Wednesday? Again, folks, you don't see this. It's the red and green of the Bloomberg screen, and John's is different than mine, Lisa's is different than John's, etc. The pulsing here of the bet, John, is tangible.
There is clearly still a massive spread between the projections in the dot plot from the last summary of economic projections and what this market is priced for. And that's going to be resolved in the next couple of months, potentially to some extent, by the incoming information and the data, not by the Fed speak. Let's wait for the data, the CPI prints and the labour market data, and it starts with payrolls tomorrow.
So here's my question. If you get an easing in financial conditions, does that matter in terms of pushing the economy further away from the goal, right? I mean, does it actually matter in a tangible way? Do you see animal spirits, or is this appropriate?
It's a really important theoretical question. You know, it's a complex question with a complex answer. But the answer, and he alluded to this, we're in new territories as we don't know.
Well, and I will say, Subhadra Rajappa of Societe Generale writing in saying that he did not emphatically push back on financial conditions or market pricing of cuts, and that is the big takeaway from this particular.
Without a doubt, I didn't get the sense he cared about that spread at all.
He didn't.
And maybe it doesn't matter to them in the way that people think it does. The chairman of the Federal Reserve, hiking interest rates 25 basis points. This is what Chair Powell had to say.
We think we've covered a lot of ground, and financial conditions have certainly tightened. And I would say we still think there's work to do there. We haven't made a decision on exactly where that will be. I think we're going to be looking carefully at the incoming data between now and the March meeting. The job is not fully done.
Except some people think it is. Equities up by 1%, Tom, on the S&P and the NASDAQ. We're up by 2 percentage points.
We are, and we have to see how it goes. And the market's still moving, still digesting this press conference. Again, the NASDAQ went under 2.2%. We need wisdom, and we get it from someone who's helped us so much over this pandemic. Jeffrey Rosenberg joins us. He's Senior Portfolio Manager at BlackRock. Jeff, I got 8 ways to go here, but the bet that we saw just played by the markets in the press conference and, frankly, after the press conference is enormous. Is it a reset by the markets?
Well, I'm listening to the discussion, and I think you're spot on here. Lisa, I think you're spot on in the comments that you highlighted. I think everybody's picked up on it. It is the reflection, it's the answer to the question around financial conditions that the market's really seized on. So there's a real disconnect between, what he said, what the statement said, maybe what he wanted to say and what the markets heard. But what the markets heard was this issue of the conflict between financial conditions easing and whether or not that would impact the Fed's policymaking. He dismissed it. Lisa, your second question, answer, it absolutely matters. It matters because it was the second thing that he said was it's important that financial conditions reflect the tightening. And so if they don't and it goes too far, it absolutely feeds back into this is how modern monetary policy transmits.